Okay, so in this lecture, we're going to start talking about something that's sort of been floating in the background in this course quite a bit, but we're going to address it more directly, and that's liquidity. So when we're talking about liquidity, what we're really talking about is the ease of buying or selling a particular asset. And this is kind of independent of whether or not that asset is valuable or not. So when you think of a liquid asset, you can think of things like treasury bills, or you can think of things like blue chip stocks. These are things that you're always going to be able to find a counterparty relatively easily. Now contrast that with something like real estate. Real estate can be very valuable, a house can be very valuable, but if you're looking to buy or sell a house on short notice, this can be pretty difficult. Right? If I have a house that I'm trying to sell right away, then either I have to accept that if I want to find a buyer right away, I have to accept a really bad price, or I'm going to have to wait until I get an offer that I like. And so this kind of encapsulates what we mean when we talk about liquidity. It's how easy it is to transact. So when we're talking about a market for a liquid asset, we want to think about a high probability of execution. It's easy for me to find a counterparty. And I want to think about low transactions costs. So transactions costs can represent both what we call order processing costs. So order processing just means the actual cost of executing the order, but they can also reflect asymmetric information. And we'll be talking about this a lot in this lecture. And when we think about asymmetric information, we want to think about, well, if I'm looking to buy or sell something that's illiquid, like a house, for example, I know something about it that the buyer may not. And being able to effectively communicate this information in the real estate market is difficult, which means that if I want to sell the house right away, I'm going to have to pay a cost in the form of accepting a lower price than I normally would want. And so what we want to emphasize is that, so far we've been talking about asset pricing a lot, and we've talked about an asset's price as if there existed just a single price that we could buy or sell as many shares as we wanted. And this is not quite the case in reality. Right? You think about if I'm looking to buy a stock, the more shares that I want to buy, the higher the transaction cost I have to pay, right? The more shares of a stock I want to buy, the higher the price I'm going to have to pay, which is what's called the price impact. And why is this? Because in the act of me trying to buy shares in this stock, I'm communicating information. I'm telling everybody, I want to buy this. This stock is valuable. And the more shares that I want to buy, the more informative this is, and therefore, the more of a premium I'm going to have to pay. So when talking about liquidity, we want to think about the buy side and the sell side. So what do we mean by the buy side and sell side? Well, what we don't mean is who's actually trying to buy or sell a specific asset. That's not exactly what we mean by buy and sell side. Instead, what I want to think about is who is demanding liquidity and who's supplying liquidity. Who is coming into this market with a need to carry out a transaction, and who is the one that's taking the other side? Who's the one that's accommodating them? So a good analogy for this, if you're a sports fan, is to think about trades in professional sports. So a trade between two teams, you can think about, well, that's on paper at least an equal transaction, right? There's no buyer or seller. But in practice, in sports, there's usually one team that initiates the trade. One team wants to do something, right? Either I want to trade for your player, right? Your player is someone that I want on my team. Or I have a player that I'm trying to get rid of. I'm trying to offload them onto you. So when I'm thinking about the trade market in sports, there's one team that demands liquidity, right? Whether you have a player that you're trying to get rid of or a player you're trying to acquire, the team that initiates the trade is on the buy side, and the team that's taking the other side is on the sell side. So think about how this would affect the kind of compensation you would get. If I have a player that I really like on the other team that I want to trade for, well, I'm typically going to have to offer a lot, right? However, if I have a player that is just as good, but who, for example, has demanded a trade I'm trying to get rid of, well, if I'm trying to offload this player to another team, and the other team is on the sell side, is just accepting this player that I don't want, then I'm not going to get as much in return as I would like. And the same is going to be true when I'm exchanging financial assets. Whoever is the one that wants to trade, whoever is initiating the transaction is on the buy side. And if you're initiating the transaction, typically you will have to pay some type of cost because you're the one that needs liquidity. You're the one that needs the service. The other person is supplying the service to you, and therefore they can collect some premium for that. We want to think about a dealer market where we have a dealer that's taking both buy and sell orders simultaneously. Now, why would they do that? Well, because a dealer is not trying to profit from the movement of the stock price. What they're trying to do is profit by offering exchange services. They're selling liquidity. They're willing to accept buy orders, but they're also willing to accept sell orders. So the price at which they're willing to buy from you is called the bid price. So for example, you might say, well, the bid price for a stock is $20, and the price at which they will sell to you is the ask price. Let's say, and the ask price is typically going to be a little bit higher. Let's say this is $23. And so the difference between the bid and ask price is going to be the spread. Now, what the dealer is doing, therefore, is they're buying from traders at a lower price and then selling to other traders at a higher price. So every time they can execute a round-trip trade, they're buying from one person, selling to another person, they're collecting this spread. Whereas for a trader, if you're on the buy side and you're the one that's demanding liquidity, if you were to buy from the dealer and then sell back to the same dealer, you would be losing money. So the dealer is seeking to profit by setting this bid-ask spread. They're not necessarily trying to speculate on the direction of the price movement. They just want as much volume of transactions to pass through them as possible, because every time they execute a round-trip trade, they're collecting this bid-ask spread. Now, the question you might be asking, therefore, is, well, how do dealers get away with charging a spread? Why are they allowed to sell at a higher price than they're buying at? Well, there's a couple reasons for this. One is that dealers bear inventory risk. So a dealer has to be willing to take whatever orders are coming in. So if you're setting a bid price of 20, as many traders want to sell to you at 20, you have to accept those trades. And so ideally, the dealer is going to have the same volume of orders on both sides, and therefore they're not holding on to any inventory. They're not accumulating a position in this asset. They're just passing through every time and then collecting a spread. However, they're not necessarily going to always be able to set their quotes in a way to balance the order flow. So there is a risk that a dealer may accumulate a significant position. And because a dealer is not trying to profit off of the price movements, this is not something they want. And so the risk of accumulating a significant position is part of the reason they're going to impose a bid-ask spread. Something related to this is called the option effect. And so the dealer is going to try and adjust these quotes as new information comes in, right? However, they can't do this instantaneously, which means that between the time that new information arrives on the market and the time in which the dealer is able to change their quotes, a trader might come in with a big trade. And here, the dealer is wide open, right? Because they have quotes that reflect an old reality, whereas a trader who's moving very quickly is trading based on new information. And this puts the dealer at a significant disadvantage. So this is another risk that the dealer faces, and they can account for this by charging a bit of a spread. So to make up for the times in which they will be too slow, they're making a profit on all those times in which they're not too slow. The third and probably the most important thing we want to consider is adverse selection. So we want to think about the dealer as not possessing any particular private information about the asset that they're setting quotes on. However, it is very possible that they could be dealing with traders who do have private information. And because they're at an informational disadvantage, and they know that they may be at an informational disadvantage, the spread reflects that, right? The fact that the bid price is lower than the ask price reflects the fact that if I'm a dealer and I'm seeing a big sell order, that's going to tell me something. And if I see a buy order, that's going to tell me something else. And so the difference between the bid and ask prices can reflect the anticipated informational effect of these trades coming in. And finally, the last two we want to think about, well, part of the cost of trading is just order processing. So this is just the cost of actually carrying out the trade. And we want to think about the possibility of non-competitive pricing. So we want to think about generally a market in which dealers have to behave competitively. I can set my quotes how I want, but there's also other dealers who are setting their own quotes. And so I can't set the spread arbitrarily wide just because I wanted to make more money, because somebody else can come along and offer a better price than what I'm offering. However, there is certainly the possibility, and arguably has been demonstrated in the past, that dealers from time to time will collude to try and fix prices to set spreads wider than they normally would set them. So the best example of this was that there was a couple of papers examining the behavior of NASDAQ dealers. Now, in the past, prices used to be quoted as fractions. So you could have, for example, 20 and 3/8. And what these authors found was that when NASDAQ dealers set their quotes, they deliberately avoided odd eights. So they would set it with maybe 1/4, 1/2, 3/4, but they wouldn't have 1/8 or 3/8 or 5/8 or 7/8. They would avoid using odd eights in their quotes. And this seemed a little bit strange. And the authors contended that the reason for this was because NASDAQ dealers were setting their quotes to arbitrarily widen the spread. If you only use even eights, well, the minimum spread you could have would be 1/4, right? Because you have one quote that's at 1/4 and one that's at 1/2, for example, and the spread would be 1/4. If you were to use the odd eights, the spread could be as narrow as 1/8. So by deliberately avoiding odd eights in their pricing, they could arbitrarily set the spreads wider than they otherwise would be. Now, probably the most damning evidence that this is what they were doing was that after the publication of this odd eights paper, all of a sudden, NASDAQ dealers started to use odd eights again. So this is probably as good of evidence as we can get that dealers do in fact collude from time to time. So non-competitive pricing also plays a role in setting these bid-ask spreads. Okay, so how do we measure the spread? Well, typically we have an ask price that's up here and a bid price that's presumably lower. And the difference between the bid and ask price is going to be called the quoted spread. So the quoted spread represents the cost of a round-trip trade. If we were to buy at the ask price and then sell back to the dealer at the bid price, this is how much we would have to pay. Well, if we're using the absolute quoted spread, this is not going to be that easy to compare between stocks, right? Because stocks have very different notional values. So the way to deal with this is rather than dealing with the absolute spread, we can think about the spread as a percentage. So we think about the spread as a percentage of the ask price. So by convention, we use the ask price in the denominator. We can also express the percent spread by looking at the difference between the log of the ask price and the log of the bid price. And so this gives us essentially the same measurement. When the percentages are small, the logs are pretty much similar to the percent spreads. So when we're dealing with relative spreads, we're typically quoting them in basis points. A basis point is 1/100th of a percent. So when we're talking about the quoted spread, we're saying, well, this would be the cost of a round-trip trade if we were to execute our trades at the prices quoted by the dealer. So we're buying here and selling here, and therefore the difference is the cost that we pay. However, there's no requirement that the transaction price actually take place at the quoted bid and ask. We could presumably have a transaction price that took place inside the spread somewhere. All right, so we're paying a transaction price that's not, for example, if we're buying, we're paying a transaction price that may not be as high as the quoted ask. So if I have a transaction that takes place inside the spread, so it takes place at a price that's better than the quoted bid and ask prices, well, how do we measure the transaction cost then? But what we need to think about is, we got to think about, all right, if we are buying, for example, we are buying at a price that is between the bid and ask price, but evidently is closer to the ask than the bid. So we are paying a little bit more. Well, how much more? We need to have some estimate of how much the stock is really worth, and then we can think about the difference in order to measure the premium that we had to pay. So for example, let's imagine that the stock's true value was here, P star, and this is the premium that we had to pay, right? We didn't have to pay the ask price. We paid less than the ask price, but we still paid more than the true value of the asset. And so we can think about the half spread as being PT minus PT star. Now, if we were to sell the stock, we would in all likelihood be getting a price that's below the fundamental value. So for a buy order, the cost of trading would be PT minus PT star. For a sell order, it would be PT star minus PT, because we would be getting a lower price than the fundamental value. So a way to simplify this expression is to define the trade direction as being +1 for a buy and -1 for a sell. So remember, every trade has a buyer and the seller, what the trade direction means is which side is initiating the trade. So QT of 1 means that the buyer was initiating the trade. The buyer demands liquidity. So the trader is the one that's looking to buy the stock from the dealer, whereas QT of -1 means that the seller was the one that's initiating the transaction. So in this case, the seller is on the buy side. I'm looking to sell shares to the dealer. And if I write it like this, I can say that the cost of trading would be QT times PT minus PT star. The cost of trading, therefore, is going to represent half the spread, because this would be the cost of a one-way transaction, right? If I'm buying the stock, this would be the trading cost I would have to pay. And if I'm selling, that would also represent the cost of just a one-way transaction. But because the bid-ask spread is supposed to represent a round-trip trade, I just call this transaction cost the half spread. So S over 2 is QT times PT minus PT star. Now, the question is, well, how do we know what the stock's fundamental value is? How do we know what PT star is? Well, there's no reason, absent some other information, to assume that somehow the quoted bid and ask prices would be skewed. So we just assume, well, the bid and ask prices should be set symmetrically around the true value. So the true value can be estimated by the midpoint of the bid-ask spread. So we can think about halfway between the bid and ask price as reflecting the true value. Doesn't necessarily have to, but it's as good an estimate as any. So when we're calculating the effective spread, we can take it as 2 times QT, which is the trade direction, times the price, minus the midpoint reflecting our estimate of the true value. So why don't we multiply by 2? Well, basically, we're assuming that if we could buy, for example, at this price, then we could also sell at a price that would be equally favorable. So equally distant from the midpoint, we would be able to take the other position. So if we were to think about a hypothetical round-trip trade, we could buy here and sell here. And so this would be our effective bid-ask spread. And you can see that compared to the quoted spread. So we can see that the effective spread is going to be narrower than the quoted spread. Now, the difficulty with using the effective spread is, well, we know what PT and MT are, but how do we know what QT is? Remember what QT represents. QT represented the trade direction, which in our case meant who is initiating the trade. Is this a buyer-initiated trade, or is this a seller-initiated trade? Now, this isn't always something that's immediately obvious, and so we're going to have to estimate the trade direction. How can we estimate the trade direction? Well, if we assume that buyers have to pay a little bit extra when they buy, and sellers have to accept a lower price when they sell, we can estimate the trade direction by saying, well, if the price is higher than the midpoint, I'm going to say that the trade direction is 1. So any trade that's buyer initiated should be above the midpoint. And any trade that's seller initiated should be below the midpoint. And if I plug this in for QT here, what we get, of course, is that this would mean the cost of trading should always be positive. So it's going to be S is equal to 2 times the absolute value of PT minus MT. When we're talking about quoted spreads and effective spreads, we're implicitly assuming that trades are not informative, right? Because we're assuming that the stock has some fundamental value, and whether you're trying to buy or sell, that has no impact on the fundamental value. However, this is not always the case, right? Because what if we're thinking about a trader that has some type of information about the stock? Then some information is contained in the order, right? Some information that's relevant to the stock's value. So depending on whether it's a buy order or sell order, that's going to have different ramifications for the stock's fundamental value. Now, what we want to think about is that trades are partially informative. So any incoming order could contain private information, but it could just be what we call a noise trade, somebody who has reasons other than some informative aspect to want to trade. So trades are partially informative. Any trade could contain information or it could not. So just the possibility that the trade could contain private information has to be reflected into the quotes. So what does that mean? Well, when we're talking about measuring the cost of trading, we can't just assume that the fundamental value is going to be the same regardless of whether it's a buy or a sell order, right? We want to think about the possibility that if it's a buy order, well then in that case, that's partially informative, right? It could just be a noise trade, but it could potentially contain information. So if I see a buy order, that's going to mean that the true value should be adjusted upwards a little bit. Whereas if I see a sell order, the true value should be adjusted downward a bit. So in order to account for this price impact, we can define what's called the realized spread. So if you recall, the effective spread was 2 times QT times PT minus MT. The realized spread is going to say, well, the current midpoint is not the best estimate of the stock's true value because the current midpoint doesn't incorporate whatever information might be contained in the trade itself. We need to wait a little bit, see this information being absorbed by the market, and then see how the quotes adjust. All right? So if it's a buy order that has some information associated with it, then we can consider the possibility that the quotes will adjust upwards. So AT plus 1 might be here and BT plus 1 might be here. And so the midpoint is going to rise. And if we use the future midpoint as our benchmark price, this is going to give us a lower cost of trading, right? So this would be the half realized spread, which is less than the half effective spread. Why? Because if I have a trade that's informative, then if I account for the price impact, right, I'm buying a stock which I know is more valuable than what the market is currently pricing it at. So if I'm going to measure my cost of trading, I don't want to use the old prices. I want to use the new prices, which reveal that in fact, I didn't end up paying as much for this stock. I didn't end up paying as much in transaction costs as the effective spread would tell me I was. The difference, therefore, between the effective and realized spreads is going to measure the price impact of the trade, which is just going to be the difference between the new midpoint and the old one. Now, all this talk about estimating spreads can be a little bit troublesome because this is not always data that's easy to get. We already talked about how trade direction has to be estimated, and even quote data can be pretty hard to get sometimes. We know, however, that we're always at least going to have access to the transaction price data. So we want to think about, well, can we come up with a model that's going to estimate the spread, estimate the degree of transactions cost if we only have the transactions prices? So this is the role model. And so the role model starts with some fairly simple assumptions. So we're going to say that the true value is equal to the midpoint, and the midpoint is going to follow a random walk. So it's going to have a drift of mu, and it's going to have a shock of epsilon. These epsilons are going to be IID with mean 0 and variance sigma squared. And we're going to assume that all transactions are going to take place at the quoted bid and ask prices. So the transaction price is either going to be A, the ask price is going to be the midpoint plus the half spread, or the bid price, which is the midpoint minus the half spread. So we can write that the transaction price is going to be MT plus S over 2 times QT. So QT is going to represent the trade direction. Once again, the trade direction just says who is the one who initiates the trade. All right, so we need to make some assumptions about how the trade direction is determined. So we're going to assume that the trade direction is random and that it's going to be a buy or a sell with equal probability. And we're going to assume that the trade direction is serially uncorrelated. So whether it was a buy or sell last period isn't going to tell us anything about whether it's going to be a buy or a sell next period. And we're going to assume that the trade direction is not correlated with the shocks to the fundamental value. So the trade direction in the role model is not informative. If there is a positive shock to the value, that doesn't make it more likely that a buy order will be the next one that comes in. So in the role model, therefore, trading activity doesn't have any relation to the dynamics of the fundamental value, which means that the spread is only going to measure order processing. It's not going to measure any sort of price impact. So we said that the price was going to be MT plus S over 2 times QT. And so what we can do is to think about, well, how does the price change? So how does the price change from period T to period T plus 1? Well, period T plus 1, we're just going to move everything forward a period so that delta PT plus 1, which is PT plus 1 minus PT, is just going to be equal to delta MT plus 1 plus S over 2 times delta QT plus 1. So the change in the price is going to be the change in the fundamental value, which is measured by the midpoint, plus S over 2 times delta QT plus 1. So the change in the trade direction. Now this is important because, well, this is just going to be random. It's going to be mu plus epsilon T plus 1. So the drift plus the noise term plus S over 2 delta QT plus 1. Now, we said that the trade direction was serially uncorrelated and uncorrelated with shocks to the fundamental value. So the changes in the fundamental value are just noise. The trade direction is also just noise. So does that mean that changes in the transaction price are just going to be noise? Well, that's a little bit different. So what we want to estimate is we want to find the expression for the covariance of successive price changes. Covariance of delta PT plus 1 and delta PT. And so we can plug in the expression we had before. Mu plus epsilon t plus 1 plus s over 2 delta qt plus 1. And the covariance with mu plus epsilon t plus s over 2 delta qt. Okay, so we can get rid of some stuff here. The mu's, well, if we're talking about variances and covariances, constants always just disappear. So we can just ignore those. The shocks to the fundamental value, those are serially uncorrelated. So they're uncorrelated with each other, and they're uncorrelated with trade direction. So those terms are all going to zero out also. So we're just left with s over 2 qt plus 1 and s over 2 times delta qt. So let's write that there. Well, s over 2 is a constant, and we can bring that out. So we have s over 2 here and then s over 2 here. So we're going to have s squared over 4 times the covariance of delta qt plus 1 and delta qt. And we can take these expressions and expand them. So the covariance of delta qt plus 1, well, delta qt plus 1 is qt plus 1 minus qt, delta qt is qt minus 1. Now we said that the trade direction was also going to be serially uncorrelated. So this has zero covariance with this and this, so we can just get rid of that term. This has zero covariance with qt, we can get rid of that term. But, well, we have the covariance of qt with qt. Qt does not have zero covariance with itself. So we're going to have a minus sign minus s squared over 4 times the variance of qt. Now, what's the variance of qt? Qt was either going to be plus 1 with probability a half or minus 1 with probability a half. That means the expected value of qt is 0, but the expected value of qt squared, well, qt squared is always going to be equal to 1. So the expected value of qt squared is 1, which means that the variance of qt is going to be 1. So this whole expression is going to simplify to minus s squared over 4. Okay, so what is this expression saying? This is saying that if I have trade direction that is simply random each period, and the trade direction is not correlated with changes to the fundamental value, then the transaction price is actually going to be negatively serially correlated between periods. Successive price changes are going to be negatively serially correlated, which means if it went up last time, it's more than likely going to go down next time. So we had that the covariance of delta pt plus 1 delta pt was equal to minus s squared over 4, which means that if we just invert this expression, we get that s is equal to 2 times the square root of the negative covariance of delta pt with delta pt plus 1. So this is called the roll estimator. So if we have a price series, we can look at the serial correlation of successive price changes, calculate that, and plug that into this formula to get an estimate of the transactions costs. By the way, this means that the roll estimator can only be used if we actually observe that successive price changes are negatively correlated. If they were positively correlated, we wouldn't be able to use this formula because we would have something negative inside the square root. How does this work? Let's think about keeping the fundamental value flat, just for the sake of simplicity. So let's imagine that the price went up last time, so that we have an uptick. Well, there's only one way that there can be an uptick, because all transactions here have to take place at the bid and ask prices. So the only way we could have an uptick is if I had a sell followed by a buy. In this case, if I had a sell followed by a buy, there's only two things that can happen next period. Either I have another buy, which takes place at the same price, or I have a sell, which takes place at the bid price. So on average, either the price will go down or it'll stay the same, which means that on average, the price will drop. So following an uptick, I will on average have a downtick. And following a downtick, I will have on average an uptick. If I were to add back the changes in the fundamental value, so I have something that, for example, looks more like a stock price chart, well, I would have to sort of trace this out, because here I'm assuming in the role model that the bid and ask prices are just going to be order processing. So the spread is going to be this kind of constant width band around the fundamental value. So excuse my drawing skills here. So here we have our midpoint, we have our ask price, and we have our bid price. So for example, if we had a buy here and a sell here, another buy, a buy, sell, 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 buy, sell, buy, whatever kind of series we want, well, if we just connect these dots, the transaction prices are going to look like this. I'm going to trace out the transaction prices. And what am I going to see? Well, first off, I'm going to see a line that looks more volatile than the changes in the quotes, right? And why is this? Well, because the trade direction being random causes the price to bounce back and forth between the bid price and the ask price. And this is called the bid-ask bounce. All right, restart slide 16. So the role model is an example of a model where I'm just dealing with order processing costs. And as a result, the only role of considering the trade direction is that it adds some noise to the price chart. Now, let's think about the alternative. What if we had a market where the trade direction was indeed informative? Now, like we said, in such a market, not every trade contains information. So we can think about a population of traders where we have some traders that are informed and some traders that are uninformed. So we can think about the informed as being insiders. So they have some kind of private information. And the uninformed as being liquidity traders. So they have reasons for trading that are not related to private information. For example, they may just have a large number of shares that they want to sell for reasons other than trying to speculate on the price. So, if I have a mix of informed and uninformed traders in the market, then every trade is partially informative. Every trade could carry information because, of course, the market maker is unable to distinguish whether a trade is coming from one of these guys or coming from one of these guys. So, we can assume that the informed traders are only going to trade when it's profitable to do so, which means that the market maker, who does not have private information, is going to lose to these guys. And therefore, they have to make up for that by profiting from these guys. They need to charge a spread to uninformed traders in order to make up for the expected losses that they're going to suffer at the hands of informed traders. Now, this creates a potential problem here because, well, what happens if you set the spread too wide? There's only so much that uninformed traders are willing to pay for liquidity. If you set the spread too wide and drive them out of the market, that's only going to leave the informed traders. And if there's only informed traders left, then the market maker was always going to lose. So this is an example of the famous Lemons problem. So basically the Lemons problem is talking about the market for used cars, and it's saying, well, the only people who want to sell their car are the people with bad cars, which means that the possibility of there being bad cars drives all the good cars out of the market. And the same way here, there are good traders, the people who are just want liquidity and they're playing fair, and there's bad traders, these insiders with private information that they're trying to profit off of. And the possibility that any trader could be informed is going to lead market makers to set these wide spreads, which is going to drive all the good traders out of the market. So a very nice model that kind of models this sort of trading process was the Gloston-Milgram model from 1985. And so what we're going to have is we're going to have a single asset, and the single asset is going to have a true value of V. So the true value is either going to be high or it's going to be low with equal probability. Okay? And then the market maker is going to receive an order from a random trader. Now, of these traders, a proportion alpha are going to be informed, which means they're going to be insiders, and 1 minus alpha are going to be uninformed. So that's going to happen for both the high and low values. So we have informed over here and uninformed here. Now the distinction between informed and uninformed traders is that they're going to behave differently. Informed traders are going to get a perfect signal of the asset's value. So if the value is high, if the true value is high, well, the informed trader knows that the true value is high, and they're always going to buy in that case. And if the true value is low, the informed trader knows that the true value is low, they're always going to sell in that case. For uninformed traders, well, they don't know what the true value is. And so they're just going to randomize. So regardless of whether the true value is high or low, the uninformed traders are going to buy and sell with equal probability. And now we're going to think about the sell side. The sell side, we're going to have a competitive market of dealers. So the dealers have to set their quotes competitively. They can't set an arbitrarily wide spread. And so the ask price is going to be equal to the expected value conditional on a buy order, right? Whereas the bid price is going to be the expected value conditional on a sell order. Now, the reason we want to use these conditional expectations is because the trade direction is partially informative. You can see that it's more likely we're going to end up with a buy order if the value is high, and more likely that we're going to end up with a sell order if the value is low. Which means, therefore, that if I'm getting a buy order, it should be more likely that the true value is high, which means that I'm going to have different expectations here compared to here. So like we said, the trade direction is partially informative. It doesn't tell us everything, but it tells us something. So what we need to do is to think about, well, what is the conditional probability of observing a buy order when the value is high? Now, on average, buys and sells will occur with equal probability because the high and low state happen with equal probability. But if I know the true value, then the orders are going to be skewed toward buys. Why is that? Well, some of the traders are informed, right? And some of the traders are uninformed. The probability of being informed is alpha. The probability of being uninformed is 1 minus alpha. Now, if I'm informed and I see the value is high, I'm always going to buy. So the probability of a buy order coming from an informed trader when the value is high is 1. For an uninformed trader, well, the uninformed trader doesn't observe the true value. This is going to be a half. So the probability of a buy order, given that the value is high, is going to be 1 times alpha plus 1/2 times 1 minus alpha, or 1 plus alpha over 2. So this means that I'm more than likely going to get a buy order when the value is high, and the probability of a sell order if the value is high, well, informed traders are never going to sell when the value is high, so the probability of a sell order is going to be 1 minus alpha over 2. So if the true value is high, buy orders are more likely than sell orders, and the probabilities are going to depend on how many informed traders there are. The more informed traders there are, the more these probabilities will be skewed, and therefore the more informative the trade direction will be. So we have the probability of a buy order, given the value size 1 plus alpha over 2. Probability of sell order is 1 minus alpha over 2. Well, now let's look at the low value branch. Without doing all of these calculations again, I set it up to be symmetric, but it doesn't necessarily have to be. When the value is low, a buy order is less likely and a sell order is more likely. So the probability of a sell is going to be 1 plus alpha over 2. The probability of a buy is going to be 1 minus alpha over 2. So now we have the conditional probabilities of buy and sell orders given the true value. So now that we have these guys, we want to turn the conditional part around. We want to think about, well, what is this? If I observe a buy order, what is the probability that the value is high? And in order to get these probabilities from these, we want to use Bayes' rule. So Bayes' rule is very simple. We're going to say, okay, well, the probability of VH given B is the probability of VH and B divided by the probability of B. Well, what's the probability of VH and B? It's going to be the probability of VH times the probability of B given VH. And what about this denominator? Well, if it's a buy order, it can either come when the value is high, which is just going to be PB given VH times PVH again, or it can come when the value is low, which is going to be PB given VL times P of VL. So we can utilize all of these things that we found here to calculate the conditional probability that the true value is high upon observing a bioorder. So PB given VH is 1 plus alpha over 2. P of VH is 1/2. So 1 plus alpha over 2 times 1/2 again on the bottom. PB given VL is 1 minus alpha over 2. And P of VL is also going to be 1/2. So what we can see here is, well, all of these cancel out. The denominator is just 1/2. And so the posterior beliefs, after observing the bioorder, you see that a high value is more likely. How much more likely? 1 plus alpha over 2 again. Now, I have to make a point here. The fact that PB given VH exactly equals P of VH given B is just a function of how I set up the model. These do not necessarily have to be the same expression, okay? Yes, it is true that if bioorders are more likely when the value is high, then the value is more likely to be high if I see a bioorder. However, these two conditional probabilities are generally not going to be the same exact expression. It just so happens that they are here because of how I set up the model, okay? And so if I do the same thing for VL, I get that the probability of VL given B is 1 minus alpha over 2. Once again, it's just a coincidence that it's the same expression as this. So what is this saying? Upon observing a bioorder, I'm going to update my beliefs and say that, well, if I see a bioorder, then it's more likely that the value is high. How much more likely? Well, it depends on how many informed traders are out there. The more informed traders are out there, the more informative the trade direction is, and the more these posterior beliefs are going to be skewed upon observing a bioorder. So we have these posterior beliefs. Probability of VH given B is 1 plus alpha over 2. Probability of VL given a bioorder is 1 minus alpha over 2. Now we can do the same thing for sell orders, and it shouldn't be surprising at all that the probability of VH given a sell order comes out to be 1 minus alpha over 2, and the probability that VL given a sell order is 1 plus alpha over 2. So again, we have the symmetry, though we have to remember once again that these do not have to be the same number. They just happen to be in this case. So now let's think about setting the quotes. We said that the ask price was the expected value given a buy order. So it's going to be the probability of a high value given the buy order times VH plus the probability of the low value given the buy order times VL. So what is that? It's going to be 1 plus alpha over 2 times VH plus 1 minus alpha over 2 times VL, or we can write that as VH plus VL over 2 plus alpha over 2 times VH minus VL. This would be the unconditional expected value. So you can think about this as being the midpoint, the expected true value, plus alpha over 2 times VH minus VL. And we can do the same thing for the bid price. So the bid price is going to be the expected value given a sell order, which is going to be 1 minus alpha over 2 times VH, because once we see a sell order, we see that the high value is less likely, plus 1 plus alpha over 2 times VL. That's going to be E of V minus alpha over 2 VH minus VL. So the bid price is going to be lower than the midpoint. So once we calculate the ask price and the bid price, we can figure out what the spread is. The spread is going to be A minus B, which is just going to be alpha times VH minus VL. So this is a fairly elegant expression, and the two terms tell us exactly the two components of the bid-ask spread. What matters? What matters is first off alpha, which is the proportion of informed traders, which tells us how informative each trade is, right? The more informed traders there are, the more informative the orders are. And the other term is VH minus VL. So VH minus VL, we can think about that as sort of measuring the variance of the true value, right? The bigger the gap between the high value and the low value, well, you can think about means that there's more information out there to be had, right? The more variable, the more volatile the fundamental value, the more valuable the information is. So we can think about the spread as being the product of how informative each trade is versus how valuable, multiplied by how valuable the information contained in the trade can be. Well, let's think about what everyone's payoffs are in this sort of model. Well, informed traders are always going to make a profit. Why? So let's say an informed trader buys. If the informed trader buys, well, they're going to pay the ask price, but they're only going to buy when the true value is high. So their payoff is going to be VH minus A whenever they buy. So if I plug in the expression for A, it's going to be VH minus the expected value plus alpha over 2 VH minus VL, which is our half spread there, which comes out to be 1 minus alpha over 2 VH minus VL, which means that informed traders are always going to make a profit when they buy. And likewise, whenever they sell, well, when they sell, they're going to receive the bid price, but they're selling something that they know only has a value of VL. And that's going to come out to also 1 minus alpha over 2 times VH minus VL. So informed traders are always going to make a profit whenever they trade. Yes, the ask price is higher than the midpoint. However, it's not so high that informed traders can't make a profit because the ask price is still going to be below the VH. It's still going to be below the highest value that the stock could take. Similarly, the bid price will be lower than the midpoint, but it won't be so low that informed traders can't make a profit from that. Well, what about uninformed traders? Uninformed traders, well, whenever they buy, they have to pay the same ask price, but because they're buying both when the value is low and when it's high, on average, they're only getting something that's worth EV. And because they can't decide what to do based on the true value, they're buying half the time and they're selling half the time. What are they getting when they sell? They receive the bid price, but they're selling something that could be high value. So for uninformed traders, on average, their payoff is negative. On average, their payoff is just them paying the half spread. Okay, so what you can see here is that the informed traders are always going to make a profit, and the uninformed traders are always going to pay the cost of trading. So you can think about this in the sense that from the market maker's perspective, the market maker is losing to informed traders, but he's making up for that by charging the spread to uninformed traders. Now, we're assuming that uninformed traders are liquidity traders. They have reasons for wanting to trade beyond just profiting from this transaction. And so we can think about, well, there is some willingness on their part to pay these transactions costs in order to carry out transactions that they wanted to carry out for other reasons. However, there is, of course, going to be a limited capacity for them to be able to pay these transactions costs. What's going to happen if uninformed traders decide they don't want to pay these costs just to be able to trade? Well, they're going to drop out of the market. And when noise traders drop out of the market, the informed traders are going to stay in. The informed traders are still making money, so they want to stay in. Whereas the uninformed traders know that they're losing money on average, and if the juice is not worth the squeeze there, they're going to drop out. Well, what's going to happen when the uninformed traders drop out and the informed traders stay in? Well, that's going to change the parameters, because now the percentage of informed traders is going to be 1. And what happens when alpha is equal to 1? Remember that the spread was alpha times VH minus VL, right? The spread does not fully capture the potential variance in the asset values because the trade is only partially informative. But if the uninformed traders all drop out, now the trade direction is fully informative, which means that if you see a buy order, it must have come from an informed trader. And if a buy order comes from an informed trader, you can then infer that the value must be high. And if you can infer that the value must be high, then the ask price must be set equal to the high value. And if you get a sell order, once again, it must come from an informed trader. And if it must come from an informed trader, and informed traders only sell when the value is low, well, the value must be low. So the bid price must be set at VL. So in this case, the trade direction is fully informative. Once the market maker gets an order, they can tell, because the trade is coming from an informed trader, what the true value is, and so they're just going to set their quotes equal to the true values. In this case, the informed traders can't make money either, right? The informed traders were only able to make money before because the trade direction was only partially informative. That the market maker would set an ask price above the midpoint, but not all the way at VH. If the ask price is all the way at VH, then even the informed traders can't make any money. Well, if the uninformed traders drop out, then, because the trade direction is fully informative, the informed traders can't make any money, the informed traders are going to drop out too. So what's going to happen? Well, the market is going to break down entirely. The entire market function on the basis of having these uninformed traders here, which were willing to take these losses so that informed traders could profit. Well, once the uninformed traders are gone, the informed traders don't have a reason to stick around either, which means that this market is just going to break down. So, in most models that have adverse selection, we can kind of get around this problem with signaling. So, what that means is that in the basic Gloston-Milgram model, the market maker can't tell whether the order is coming from an informed or an uninformed trader. They look identical to the market maker. But what if the traders could send some type of signal to be like, hey, look, I'm not an informed trader. You can trust me. I'm not trying to take advantage of your prices here, and so you can give me a better deal, right? Well, does this sort of signaling work? Well, I think the problem with this is pretty obvious, right? An uninformed trader would want to send a truthful signal because an uninformed trader would want to truthfully signal that they were uninformed because this is what the market maker wants to see. Whereas an informed trader, well, the informed trader would have no incentive to send a truthful signal. They would want to portray themselves as being uninformed too. It's like, no, I don't have any private information. To perish the thought that there's no way that I could be trying to exploit you, right? So this makes it difficult to price discriminate because any sort of thing that you could use to distinguish between informed and uninformed traders, once informed traders realize that market makers are doing this, they're going to try to look for ways to disguise themselves as uninformed traders. So for example, if we were inferring whether a trader was informed or uninformed by looking at the volume, right, of the order. So we can imagine that maybe informed traders, because they're trying to take advantage of mispricings that they see, are going to be more likely to submit bigger orders. Well, if we say, okay, well, if it's a big order, it has to be an informed trader, small order, more likely to be uninformed, so we're going to set more favorable quotes for smaller orders. Well, informed traders are just going to respond to that by breaking up their trades into smaller chunks. So signaling is a way that we can use to get around adverse selection problems, but it's always going to be problematic because traders are always going to want to disguise themselves to get the best price.